Hi guys, welcome to our second educational piece on trading the ASX. Since we're in earnings seasons at the moment, I thought what better time than now to dive into the fundamental analysis aspect of our trading education content. We'll be using the MooMoo platform in order to find everything we need in one place when it comes to the analysis that we'll be doing today. If you check out the link below, MooMoo is giving out a generous sign up and deposit offer of 10 free stocks for a $2,000 deposit or 3 free stocks for a $100 deposit, as well as a 6.8% interest on trading account balances for 30 days and for up to 80,000 Aussie dollars. Also, you'll receive 2,000 Aussie dollars and 2,000 US dollars for Aussie and US brokerage fee coupons for the first 30 days once activated. MooMoo also has one of the cheapest commission rates for ASX CHESS sponsored stocks as well as US stocks. So make sure to check out the link below for more details, and just like any other promotion, make sure you check out the terms and conditions before you sign up. In this episode, I'm going to cover 3 fundamental resources key to trading the markets: EPS, PE ratios, and dividends. First, we're going to take a look at EPS, which stands for earnings per share. You can find this information here on the MooMoo app. And if you're using the app on your phone, simply select the stock you're interested in, click on Company, and then scroll all the way down to the bottom until you reach the Financial Indicators section. And from here, you can see the current and previous earnings per share for the company. EPS is a measure of a company's profitability for each share of its stock. Imagine a company as a big pie, and this pie represents all the profits the company makes. If you own a slice of the pie, which means you own a share of the company, EPS is basically telling you how much profit from a single share of pie you're getting. But here's how it works. The company's total profit is divided by the number of shares they have. So if the company has $1 million in profit and there are 1 million shares, the EPS would simply be $1. This means for each share you own, you're getting $1 of profit. The stock price is often influenced by EPS and valuation ratios. The market often determines the stock price by multiplying the EPS by a valuation ratio, such as the PE ratio, and we'll get into that shortly. So the EPS is useful because it helps investors figure out how profitable a company is and compares it with other companies. A higher EPS often indicates that a company is doing well financially, which can be a good sign if you're thinking about investing. You may have noticed on the MooMoo app there is TTM and LR. So what is the difference between these two? Well, TTM is trailing 12 months and LYR is last year. They both measure a company's EPS, but they focus on different time periods. So EPS TTM is trailing 12 months, and what that means is it's a measure of a company's earnings per share over the recent 12 months. This can include quarterly and half-year results. And how is it calculated? Well, it takes the total earnings of a company for the last 12 months and divides it by the number of outstanding shares. And why does it matter? Well, it provides a more current view of a company's performance, incorporating the latest data and accounting for any recent changes in the company's financial situation. EPS LYR stands for last year. This measures the earnings per share for a company's most recent fiscal year. How it's calculated is that it uses the earnings figures reported in the most recent full fiscal year and divides it by the number of outstanding shares. And why does it matter? Well, it's useful for comparing the company's performance year over year, but it might not reflect the most recent fiscal trends if the fiscal year ended some time ago. If you guys aren't aware, I've recently got back into longer term trading and investing for both the ASX and the US markets. In order to do this efficiently and with the cheapest brokerage, I've moved over to MooMoo, who allow me to trade both markets at the lowest cost, and without any kind of patent day trade restrictions on the US. So a shout out to MooMoo for sponsoring this content. When we compare MooMoo to other brokers like CommSec, CMC, NabTrade, MooMoo charges significantly less on commission for CHESS sponsored ASX shares from just $3 Aussie per trade. And that goes the same for US trading as well, where the cost is significantly lower than other brokerages like ComSec, SelfWealth, and Stake, where commission for MooMoo is only 99 cents USD. Now we're going to take a look at PE ratios, also known as price to earnings ratios. PE ratios are a simple way to look at how much investors are willing to pay for each dollar of a company's earnings. It's like a quick snapshot of how a stock's price compares to its profits. This is where you can analyze the PE ratios on the MooMoo platform. It's just located here in the top right corner. And if you're using the MooMoo app on your phone, select the stock, click on company, and scroll down until you get to company valuation. From here, you can see the current PE as well as its recent history. So how does PE ratios work? Well, we're going to take a look at two factors. First is the price, and this refers to the current price of one share for a company's stock. Then we take a look at earnings, and this is how much profit the company makes per share, which is the EPS that we just covered. So the PE ratio is calculated by dividing the stock price by the EPS. For example, if a stock has $50 per share and its EPS is $5, the PE ratio would be 10. This means that investors are paying $10 for every $1 of the company's earnings. So why is this useful? Well, the PE ratio helps investors gauge if a stock is overvalued or undervalued. A high PE might mean the stock is expensive relative to its earnings, or it could mean that investors expect future growth. Whereas a low PE might indicate that the stock is cheap, but it could also signal that a company is struggling or that its earnings are expected to decline. So how can we use PE ratios? It's handy for comparing between different companies. For example, if you have company A and company B and they're quite similar, yet company A has a PE ratio of 15 and company B has a PE of 30, you might think that company B is more expensive relative to its earnings. In short, PE ratios give you a quick way to see how much you're paying for a company's earnings, which can help decide if a stock is a good investment based on your expectations for the company's future performance. So whilst PE ratios are a useful tool, they shouldn't be used by themselves, but rather as a combination with other fundamental analysis. Next, we're going to take a look at dividends. This is where you can find dividends in the MooMoo app in the top right corner. And if you're using the MooMoo app on your phone, select the stock you're interested in, click on company, and then right below that, click on dividends. From here, you can see the next upcoming dividend payment, as well as its recent payment history as well. So what are dividends? They're basically a way for companies to share some of their profits with their shareholders. Think of it like a thank you gift from the company for owning their stock. And here's how it works. A dividend is a cash payment most often. However, sometimes it can be a share of a stock that a company gives to its shareholders. It's typically paid out on a regular schedule, like quarterly or half yearly. And how is it decided? Well, a company's board of directors decides if and how much to pay out in dividends. They look at the company's profits and decide how much money it needs for future growth or other expenses and other factors. So how is it paid? Well, if you own shares in a company that pays dividends, you'll get a certain amount of money for each share that you own. For example, if a company declares a $2 dividend per share and you own 100 shares, you'll end up with $200 in dividends that ends up in your brokerage account. So why are dividends useful? Well, they're primarily used as income. Dividends provide a regular income stream for a variety of shareholders, which can be especially attractive to those who want to earn steady cash flow. It's also a signal of health. A consistent or growing dividend can signal that a company is doing well and has stable profits. It shows confidence in its ability to keep generating earnings. So what's the appeal? Well, some investors look for dividend-paying stocks because they offer a way to earn money even if the stock price doesn't go up. It's kind of like getting paid for just holding onto your own shares. So in summary, dividends are a way for companies to share their success with their shareholders by paying them a portion of their profits, providing them income and a signal for the company's financial health. That's the end of the video, guys. Please remember to check the link below for MooMoo's promo on how you can get 10 free stocks, 6.8% interest on trading account cash balances, plus $2,000 Aussie and $2,000 USD worth of brokerage vouchers for the first 30 days once activated. Please leave a comment below and let me know your thoughts about the content and the MooMoo platform. Thanks, guys.